Good morning and welcome to this Tuesday, October 17th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. We did get retail sales in this morning, and they were hotter than expected. And of course, the 10-year Treasury yield has responded to the upside as traders flee bonds once again. The retail sales number came in. The core number rose 0.7%. The market was expecting 0.3%. Also, and that was for the month of September. Also for the month of August, that number was revised higher from 0.6% to 0.8%. If we strip out the vehicles, retail sales still up 0.6%. Which was 3 times as much as expected. The expectation was for a rise of 0.2%. And also the prior month, August, was revised quite a bit higher from 0.6% to 0.9%. So the hot numbers that came through retail sales this morning certainly having an impact on the 10-year Treasury yield. Last time I looked, we were up about 11 or 12 basis points there, back up above 4.8%. Not too far from the 4.89% where we were when the Fed first came out with their announcement. And then, of course, we saw the bond yield take off to the upside. But the stock market's been holding up pretty well. We do see futures down a little bit this morning. Currently, I show the Dow down about 0.3% with that retail sales news. Spider down about 0.6%. The Nasdaq, or the QQQ, Nasdaq 100, down about a little bit more than 0.8%. And the IWM down just a little bit less than 0.6%. So certainly market going to get off to a little bit of a rocky start this morning, but not too surprising considering the retail sales number came in higher than expected and the prior month was revised higher. So, when I look at this, the bad news is that, of course, these types of economic news or reports that show the economy still pretty hot overall, or even hotter than expected, keeps the Fed on notice about possibly having to raise rates. Of course, you have inflation on the other side that's been coming down steadily, maybe telling the Fed to take their foot off the accelerator and maybe tap on those brakes for a little bit longer, maybe for quite a while. So, I think you've got two different factions here really battling, and that's why we're seeing the market overall consolidate. The good news is, though, if we finished where we are right now on the 10-year Treasury yield, it would be higher than we have seen in recent months. But the S&P 500 is quite a bit off the lows. So just like last October, when we peaked on the 10-year Treasury yield, and of course, the stock market was at the bottom of the cyclical bear market, we went all the way back up and tested that 10-year Treasury yield. Meanwhile, the stock market, the S&P 500, was up 1,000 points during that period. So I think what the market's doing is it's acclimating itself to a higher interest rate environment, not too high, but higher. And I think we're going to be in this range from probably 3 to 5%, maybe for the next couple of years. That's my feeling. But we'll see how it goes and see whether or not rates keep going up. Obviously, if rates keep going up, that is going to pressure equities at some point. They're not going to just equities will not keep going up if rates keep going up. So we do have to watch it. But the Fed has talked about maybe one more rate hike. News this morning definitely not helping in that regard. And we'll see, how the Fed plays this as we go forward. One thing for Earnings Beats members, before I forget, I made a mistake personally when I sent out the weekly market report yesterday. I actually grabbed the wrong screenshots, which is why the scrolling issue returned more than it has in the past maybe couple weeks. I had kind of found one solution in that it was just really blowing up any image on the Excel side, any Excel spreadsheet that I tried to take a screenshot from was really it was difficult to get it to fit and still be legible. But this was completely separate issue. It was just a mistake on my part. I grabbed the wrong screenshots. And after I did it and I sent the email out, I was like, uh-oh. And I immediately went into my email and I saw it. So my apologies. That was my mistake. None of this is going to matter soon because we are going to change our format completely. But I know it is frustrating to have to scroll, with those huge images, to have to scroll out with the to read and actually go across and scroll back. I get it. So we'll definitely have that resolved. And again, probably within the next couple of weeks, we're going to have a whole new format. It's not going to matter anyway. So try to concentrate on the content and not so much on the format because again, I'll take the responsibility on that one. I messed up when I sent it out yesterday. Anyhow, let's take a look at what happened yesterday. Let's get this thing started. I really see some good signs, but the market at this point, really, it's difficult for the stock market to go higher as long as those interest rates keep jumping to the upside and threatening the aggressive move. Money's been rotating into aggressive stocks, whether you realize it or not. And so that I think bodes well for the market down the road. But we keep getting these hiccups a lot of times with the 10-year Treasury yield making a quick sudden move to the upside. And that is certainly not helping the bulls in their case to take prices higher. Yesterday, bulls did take prices higher, but that was yesterday. Today, we got a different story. Dow Jones Industrial Average yesterday was up 314 points, almost 1%. S&P 500 up 46 points, a little more than 1%. Nasdaq up almost 1.2%. That was a jump on the NDX of 178 points. Mid caps rose 40 points, 1.6%. Small caps up nearly 3 points on the Russell 2000, the IWM ETF that tracks the Russell 2000. That was up more than 1.6%. Transport's up 1.9%. So we're starting to see a little bit more of that rotation back into the transports after a really rough period, a couple months. And so the market's stabilizing here. We have stopped the bleeding to the downside, but we haven't exactly done everything we need to get this new uptrend started. So we continue to sideways consolidate. We do have a rough historical week ahead of us. Next week is one of the worst. Actually, technically, I think it has been the worst week of the year going back to 1950. And you think, oh, that was because of Black Monday. Actually, Black Monday, 1987, was October 19th. And this period that I'm looking at is actually October 21st at the close to the 27th at the close. So basically engulfs next week. The good news, though, is once you get past that week, we start the best historical period of the year. End of October through about the middle of January, undisputed leader in terms of historical strength in U.S. equities. I think it's the October 27th close to the January 18th close on the S&P 500. It's risen 62 of the last 73 years. So pretty strong odds that once we get past the end of next week, the market will move higher over the next 2 months and 2 2/3 months, something like that. So got some good historical data ahead of us and a historical period ahead of us, but we do need to get through the rest of this week and then, of course, next week. Earnings starting to come out in force, so that obviously is playing a role as well. Yesterday, discretionary stocks. First of all 11 sectors were up yesterday. I always like to see those kinds of days. But again, we'll see what happens today. Now with rates up, retail sales stronger than expected, we're seeing that pullback in futures. But yesterday, discretionary up 1.6%, communication services up 1.6%, industrials up a little over 1%. Those were the three groups that led the market yesterday. Those are all three aggressive groups, although XLY and XLC are what I would consider the more aggressive. We like to see industrials and financials do well, but they don't generally lead the S&P 500. Normally, we just want to see them going up along with the S&P 500. But we are in a period of the year when industrials and financials do tend to perform better than the S&P 500. The fourth quarter is nirvana for financials and industrials historically. Of course, that doesn't guarantee us anything this quarter, this month, or next month. But if you go back and look at history, this is the time of the year when financials and industrials generally do very well. Leading the discretionary to the upside was the clothing and accessories group, jumping over 7% yesterday. Lululemon, LULU had a big day. It's part of one of our portfolios. So LULU certainly helping out there. Publishers, next up, also had a very strong day, up more than 3%. That group helped to lead the communication services. And then finally, industrials led by trucking. The truckers jumping more than 2.25% yesterday. So all in all, pretty strong day across the board, but these were some of your leaders. 10-year Treasury yield. Let's get a quick update, see where we are. Still continuing to move up, 4.83%, up a little bit more than 11 basis points this morning. And as you can see, that would be a closing breakout if we finish there today. So we'll see what happens intraday. If we move up intraday and come back down again, leaving a long tail above 480, close below 480, maybe that's a good sign. Also, one other thing I would point out is if we do make a breakout here, just keep in mind right now we have a negative divergence, which could lead to further weakness in the 10-year Treasury yield down the road. And I'm talking about maybe over the next few weeks. We could see maybe a move down to the 50-period moving average, which is down closer to 440, but it is rising every day. So maybe we go back up, threaten this 490, maybe even threaten 5%. That could spook the market, the stock market for sure. We'll see. But maybe we have that in the cards, and then that positive divergence kicks in. Maybe we just go back down and retest the recent low, which in a few weeks, we will probably see that 50-day moving average also up close to that 453, 455 area. So that's kind of where we stand right now. Yields continuing to move up. That could spark a sell-off in equities. We'll see. Good news is we bounced quite a bit off the recent low, so we have some room to absorb any short-term weakness that we might see. But we probably want to save some of that for next week, just historically, based on the fact next week's not great. Anyway, that's kind of the summary I see right now so far on the, or at least what happened yesterday and what we see on the 10-year Treasury yield. Moving on to the S&P 500, this is what I was referring to. If I pull up the 10-year Treasury yield, I'm going to put this down on the bottom of this chart. If you pull this up, you'll see that as we were going up on the 10-year Treasury yield, obviously equities were going down. You go over here as the 10-year Treasury yield was going up from mid-July all the way through middle part of August. You can see from the middle part of July, middle part of August, mostly, we were going lower in equities. We pulled back on the yield, and that's when we got a little pop in the U.S. equities. And then we had the big run again. There's your sell-off. But now we're right back up to where we were, and we're still sitting up here a little bit away from that recent low. So that's what I'm just talking about. If we get back up to maybe 490 or even 5%, we still have these lows down here to maybe protect us against any future drop. So I'm going to watch that 4,200 level on the S&P 500. I think to the upside, you got that 50-day moving average right around 4,400. The fact that we've gotten back up through 43.05 and 43.35, I think is a good sign. But we still have more overhead work to do. And also the fact that we've gotten back through the 20-day moving average. Now, it's not like we've actually exploded through the 20, but we are holding it. We've now closed above it for the last 5 trading days. That's a pretty good sign to indicate that you're in a sideways consolidation period versus a more significant downtrend. So that's the way I'm continuing to view it. And a lot of my beneath the surface signals continue to point to higher prices later in the fourth quarter. So I have no choice but to continue to view this as more sideways consolidation. Looking at the Nasdaq 100, same thing, except the recent lows have all kind of held. We went a little bit lower here at the end of September, but for the most part, the lows we saw in June and then again in August have mostly held. And I mean, it seems like we're only a good solid week away from the Nasdaq 100 potentially moving back to another high. We just need a solid 1 week, kind of like we saw back at the beginning of June, maybe anywhere throughout May or even mid-July. That was right around earnings. We're getting that little bit of that move as well. And this is typical, by the way, moving up when earnings season is about to kick in, usually starting in late September, early October. That's when we normally see the S&P 500 move higher. That's what we're seeing right now. July, normally see the same thing through July. That's what we saw. So historically, it's kind of playing along the lines that we typically see. But again, next week is a little bit more bearish, or a lot more bearish historically. And so we'll see how that transpires. But the good news is, it's one of those things where you see the sky and it looks really nasty coming towards you, but then in a very far distance, it looks like a little brightness, like there's a little bit of clearing after the storm. That's kind of how I'm viewing the market right now. I'm looking historically, seeing these clouds on the horizon for next week, but realizing that after that, we've got probably clearing skies, at least again, historically. We'll see whether or not it holds up this year. IWM, here's the small caps. We had a nice move up, failed at the 20-day moving average, moved down, and we actually set a positive divergence on the IWM. So if we go back down there again, it's just building on an already established positive divergence. Now, what's interesting here is when you look at it, you might say, well, you can't have a positive divergence because you haven't set a lower low, right? Here's the lows from early October. Here's the low just recently. We didn't break to a new low. We do have a higher PPO, but how does that make it a positive divergence? Well, remember, the PPO or the MACD, if you follow the MACD, they're based on closing prices. These are candlesticks showing you intraday moves. How about if we switch this and show closing? So we get rid of the candlesticks and we show a solid line chart. So this is only going to connect the closes. Check this out. Here, you can see the closes did go to a new low close. So now you can see lower close, higher PPO. Remember, the PPO is not based on those intraday prices. It's based on the close. So now, for the first time during this downtrend, we actually have a positive divergence on the IWM. Now, again, that doesn't mean that right away we're going to shoot higher. It's just it's a signal. Don't treat it as anything more than a signal. It's a secondary signal. Price always dictates. Price volume is always my number one indicator. Divergences, AD lines, relative strength, anything else I talk about is secondary to price action. Now, they can give you some really good clues, all those other signals, especially when they all start to line up together, but you still have to pay attention to the number one signal, which is price volume. I'm still encouraged, though. I like this positive divergence. This pullback intraday went below 170, but we have seen a lot of support over the last year just below 170. So even if we closed yesterday 173.02, even if we drop a couple percent from here and get back into the upper 160s, we're still at major support, and it will all come with a positive divergence in play. So I think things are starting to build more and more bullishly on the charts in terms of price action, but we have to let this play out. And again, next week, historically, at least be aware that it can be problematic. And it's not 100%. It's not like it goes down every year, but history tells us when it does go down, we need to be careful. Transports, you can see put in their low at about 14, call it around 14.7 on a closing basis, bounced, went back down, got very close. I don't know that we got a new closing low, but we do see that PPO moving higher. So at least momentum is starting to turn a little bit more in the bulls' favor. That's kind of where that stands right now. Let's go over to earnings beats for a second. Earningsbeats.com. If you are new, first of all, thank you. We certainly appreciate you tuning into the show. Tell your friends, tell your parents, grandparents, your kids, your grandkids, whatever, anybody interested in the stock market. I think we do a pretty good job of calling the market, both on the long and the short side. I'm going to tell you that I lean mostly to the bullish side because market goes up a lot more than it goes down. But if I see the signals that tell me the market's in trouble, I will pass it along. I think I look at the market pretty objectively, despite what some bears think. I have been bullish this year, but hey, you want me to apologize? Market's been going up all year. Yeah, we've had a pullback last couple months, and back in middle July, I wrote about it, talked about, hey, we got some issues ahead. This is the issues. These are the issues we've been dealing with. They've manifested themselves into almost a correction. We haven't lost 10%, but we got close. Do we go down 10%? I don't know if we get down quite that far. I think maybe we got the low already, but we'll see. If we don't go down lower next week, I do believe that the low is in, and I expect we're going to have a typical seasonal fourth quarter, which means stronger prices. But anyway, if you want to learn more about us at Earnings Beats, obviously follow the shows, go over to StockCharts, follow my blog where I write. Those are free articles. But we have a free newsletter. That's our Earnings Beats Digest. Name and email address is all it takes. Make sure you hit that subscribe button. 3 times a week it's delivered, Monday, Wednesday, and Friday. And normally it's a very, very simple read, couple paragraphs and a chart. So if you want to just get some tidbits, information, start to learn a little bit more about the market. If you're new to technical analysis, it's going to help you. If you're new to just trying to figure out the market, what really makes sense, because I talk a lot about common sense. The stock market's a lot more about common sense than you might think. Everybody gets so upset, and you listen to the news, and of course the news is going to tend to brainwash you. It just is. If I watch news or if I read articles, immediately I begin to question some of the things. I have to try to focus and tune all that noise out to make what I believe are really good, solid, objective calls in the market. Once you get tuned into all that, CNBC rhetoric, they're trying to fill airtime all day long. How do you do that? Well, it's entertainment, number one. You got to come up with something that's entertaining. You got to come up with something that scares the heck out of people. That'll get you to tune in. That's unfortunately the way news today works. Scary wins. And so you're going to hear a lot more about how the market's going to go down and all the problems we have than the good things that are going on in the market. So a lot of stuff that should be reported on CNBC, unfortunately, is not. Today's chart, what I wanted to show you, this is a long-term chart of the XRT. This is the ETF that tracks the retail group. So it's the SPDR S&P Retail ETF. And notice it's just been going sideways here for the last year or so. So the market been rebounding, but we haven't really seen a lot of strength in retail. However, we have seen support hold around 54 to about 57. And right now, well, yesterday we closed at 60. I think we were down a little bit below 60 just a little while ago. So we've got some issues here as we go sideways, but we are holding on to support. If I annotated this chart, I think the area, clearly this level was big because it represented a lengthy high that we hadn't cleared in a while. So once we cleared that and we had a little bit of chop in here, but the subsequent low was right here. And then in this chop, the last high was right here before we made this huge move up at the end of 2020 and throughout 2021. So I kind of view this area as major support zone. And I think really this latest breakout is your initial support. So I'm going to say initial support really comes in at about 53 on the XRT. So we got about 10% potential to the downside to get down there. Recent lows, 54 over here, maybe 56 here, 56, maybe 57 here. So that mid 50s range clearly is a lot of support for the XRT. I don't know if we go down there. I just wanted to point this out. With that strong report coming out, you might wonder, why in the heck is retail going down? We just had a great report in retail. And so that doesn't exactly line up from a common sense perspective, but you have to think about the way the stock market interprets strong economic data. They interpret it as though the Fed might not be done raising rates. And if we're going to keep seeing rates going higher, that's going to have an impact on consumers. And consumers are then going to maybe tighten their purse strings. And that is why we're seeing retail go down. I don't think that's going to be the case. And I do think eventually we're going to see this group turn back to the upside. But we really need to get past all inflationary threats so that the Fed can simply look at the economy, because there are signs the economy is weakening. Not a lot of signs. We still see some signs that the economy is pretty strong. And to be quite honest, with inflation, if inflation keeps coming down with the economy still showing a lot of resiliency, that's nirvana for US equities. Nirvana. Inflation coming down, economic strength. I don't know that you can get anything better for stocks. So the environment isn't as bad as a lot of people think. The question is, does inflation rear its head? Because we've had a steady decline. If it does turn back around and move back to the upside, then the Fed faces the potential of more rate hikes. And that, at the current rate where we're at now, I agree with all the bears out there. We can't really stand for another series of rate hikes at this level. Folks are going to start getting out of the stock market, moving into fixed income. That's going to be, I mean, that's the problem when you're in the stock market, is when you have a major shift in asset class. It has nothing to do with how good Apple's doing or Microsoft doing or any of these other companies are doing. It has to do with the fact that some investors are going to get out of the stock market and take that fixed yield if it gets up high enough. Some might say 4.8% is high enough. I don't think it is. 5.5. I think 6 definitely is. 5.5 is kind of the gray area for me, just historically going back decades. So let's keep an eye on that. But anyway, that's why I think retail is reacting the way it is, and the reason why it just hasn't done well here over the last couple of months, because rates keep going up, and the Fed is continuing to talk like they want to take the economy down. Obviously, retail stocks would be impacted by that. All right, I wanted to give you the last month of action on the various sectors. So here's the last 1 month, and this is how each of the sectors performs relative to the S&P 500. So any of those that are showing green have outperformed the S&P 500 over the last month. Any of those in red have underperformed. Now the S&P 500 encompasses all these groups. So you're always going to have some green, some red. You can't have them all green. You can't have them all red. Some of them have to outperform the S&P. So when I look at this, I'm looking at communication services and technology, 2 aggressive growth areas of the market, leading for the last month. Now, the Fed meeting wasn't quite a month ago. It was September 19th and 20th, I believe. And today is October 17th. So by the end of this week, we will now have a full month since that Fed meeting. And since that Fed meeting, with the Fed talking about higher rates and then the 10-year Treasury yield shooting up, look at the 2 groups that are leading. Groups that you would think would get hit rather hard by higher interest rates. These are groups that have companies that depend on the acceleration of growth in the future, and also that future earnings growth is discounted back using current interest rates. The higher the rates go, the more discount is applied. Those future earnings look weaker and weaker as rates climb. So as rates go up, you normally would see the valuations of these companies going down and underperforming the S&P 500. Instead, we're seeing the opposite, which means one of 2 things. Either the stock market's not buying, Wall Street's not buying rates staying up for very long. That's number 1. Or number 2, that the economy can still withstand interest rates at this level, and these companies are continuing to grow at a rate that surpasses the increase in the yields that we've seen. So either the strength ahead is going to be strong enough where it doesn't matter that rates go up a little bit, or rates are peaking and we're going to see them level off. The market would love these 2 groups really in either one of those 2 scenarios. Now, the one aggressive group that has not been performing well, you can see discretionary right down there with staples, though. So it's not like Staples are up here at the top and discretionary is down at the bottom. They're both low, which tells me it's just consumers. You know, the market right now is a little concerned about consumers potentially being weak as we go forward because of what the Fed's doing with interest rates. I think if the Fed signals at some point, and they will at some point, that they're done, when they signal, I believe discretionary will be your strongest group coming out of that. But we'll wait for that. Not the case right now. Anyway, I still look at this as being pretty bullish. I mean, communication services, technology, industrials, 3 of the 5 groups have been outperforming essentially since that Fed meeting. Financials, slightly underperforming. And then discretionary, the only one that's showing considerable weakness. And Staples is just as weak. So that relationship between the two has kind of held steady. It's not going down. So I view all of that pretty bullishly as we go forward. All right. It is 9:31, so the market has just opened. I wanted to show you something from the last 2 years because I always talk about the January effect. And that's what I call it, the January effect. Some people call it the January barometer, whatever. I like to call it the effect because I do think January has a major effect on the rest of the year. January 2022 was weak. And I've broken down all of January's on the S&P 500 for the last 73 years. And I've broken them down into quadrants. The best 25% of January's go into quadrant 1. Then the second best go into 2, third into 3. And then the 25% of the weakest January's goes into quadrant 4. In 2022, we had a horrible January. It placed us right in the middle of quadrant 4, one of the worst Januaries on record. And the whole January effect argument is that as goes January, so goes the rest of the year. So if January is down, then what we should expect is from the beginning of February to the end of the year would be down as well. And if you look at it, quadrant 1, if you're in one of the best Januaries, you go on to rise the next 11 months. You go on to rise 16 of the 18 years, or 16 of those 18 Januaries that are in the top 25%. You keep going higher the balance of the year. January 2023 fit perfectly into quadrant 1. I think it was like the 6th or 7th best January on record since 1950. And look at what we've done. Balance of the year is higher. And I think we're going to continue to go higher. The average return, of those 16 or of those 18 years, the average balance of the year return is up 15%. That doesn't include January. So we finished January somewhere around under 4,100. So 15% would be another roughly 600 points, which would take us to 4,700, which at the beginning of the year was my target. And I still believe we're going to get to 4,700 by the end of the year. We'll see. Obviously, we've got to negotiate this next week or two, get into that bullish period, and then I think the market's going to do what it typically does, which is rise. All right, let's see what the market's doing. Right now, it's not rising. You can see the Nasdaq down over 1%. Small caps actually not down as much as it looked early in the day. So maybe small caps still continuing to show a little bit of relative strength. That group's been weak, and it's got a lot of work to do to get back through the 20-day moving average. But remember, it does have a positive divergence in play. And so a lot of times now we start to look not at the 20-day, but in this case at the 50-day as the next potential move. And that would be significantly higher on the IWM. So that's something to keep an eye on. Nasdaq has been the leader. It's taken it on the chin a little bit today. We'll see whether or not that continues. But overall, I think the market has been pretty resilient, and we are sideways consolidating or chopping or whatever it is you want to call it. But we are off the recent lows. Watch the VIX. 20 has been a brick wall for the VIX on closes. If we break above 20 short term, I think you have to respect that. And for me, it means taking a lot less risk in the market on the long side, but it needs to close above 20. As long as it stays below 20, and especially if it starts to work its way back down into the mid-teens, that would really bode well for equities. All right, that's it for me. I'll be back tomorrow at 9 a.m. for your next Trading Places Live. Have a great day, everybody, and spread the word. Have them come in and watch the show. Thanks to all of you. Make sure you hit the like button and be sure to subscribe to our channel. Have a great day, everybody. Happy trading.